Hello ladies and gentlemen. We'll start the review of the week with TLT, which is now, as we can see and as we predicted, trapped in a very small range. It is basically going to trade between 122 and 117, let's call it, and that is now reflected in the yields that we can see. The Bollinger Bands are coming down, the moving average is catching up. So we are going to spend some time between 320 in the 30-year and basically the 295 area. We are just stuck until we see something either out of the Fed next week, which is unlikely in our opinion. We are much more likely to see something out of the Fed, and which is market moving for TLT and for 30 years much later on when we get some GDP figures which could be inflationary, and then we could see a move higher. But in any case, it is tough to make an argument that we will see much action over the course of the next couple of weeks in TLT or bonds. The picture in the 10 years is much the same. The market basically has traded in a very narrow range all week, 1, 2, 3, 4, 5 days, and the market basically has moved a basis point. The likelihood eventually is that we do break higher and that we fill these gaps at the very least around 305. That could be on the back of the Fed, but again, as we just said, we doubt it. Certainly the yield curve keeps on flattening for the time being, and for the next few days certainly, and we could see very much the Fed indicate an end to the tightening cycle, if not now, then at some stage in the near future, which would calm the market down. The market would get its 3 hikes for the year and say, that's it, we are done, we know how to reprice this, and then we could see a fall in yields unless we get inflationary figures. But we do think that for the time being, the path of least resistance is for higher rates, eventually lower, but for the time being definitely higher. We are also approaching ECB, so as you can see, the market is doing very well technically. It is this is the German Bund. It basically trades on the lower weekly Bollinger Band and bounces. This behavior is evident in the 5-year as well. The 5-year is more under pressure, and it trades through the Bollinger Band slightly more, simply because the Italy effect is still so strong. People are fleeing for the safety of the German bond market, and therefore the 5-year area or the shorter periods are more under pressure. So if you want to go short, you basically look for the bunds. The bunds are at some stage, we think, depending on what the ECB says, and we think the ECB is actually going to be quite bearish, going to certainly try and trade towards the 55 basis point area. So that's a good 10 basis points higher together with the US. We certainly don't think that we will be trading sub 35 for any length of time in the Bund. Still looking very much for at some stage having significantly higher rates in Europe. If we now look at what Italy has done, then this is the effect. It is way through the Bollinger Bands, but we think at some stage over the next couple of weeks it'll come back towards them around 270, and then we see what happens. But while Italy doesn't the political situation in Italy doesn't settle down, this pressure on the Italian curve is going to continue, and that will make sure that the short end of Germany is anchored and bid. And that uncertainty in bonds in Europe is actually being reflected in the uncertainty in the stock market. If we have a look at a weekly chart, we can see that the stocks finished down on the week, very slightly, but still down. It could not hold the gains, and you can see where all these moving averages are between 34.94 and 35.17, which we indicated last week. That is the level that we need to break to see a follow through in equities. Our big bet at some stage during this year will be buy European equities, sell European fixed income. The trend has not started yet. We don't see any point in jumping the trend. The trend will start when we close a week above 35.20. That will be when we can actually expect that big move to happen, and then we could see significantly higher prices in Europe. For the time being, the trend has not started. There's no point in anticipating something which will be very large. DAX cash also is sitting right on top of these moving averages for the weekly. It is not giving us any clues as to what is happening. We are constricting rapidly. That probably means several more weeks of uncertainty before we think we see the final leg up together with the stocks. But the stocks on the upside will definitely outperform the DAX should the breakout in Europe happen. The dollar actually has done exactly what we thought it would do. It came off, and now we have the constriction in the Bollinger Bands, and we will basically trade in this area between 92.50 and, let's call it here, 94.30. This will be a 1.5 to 2% range before we get the next move. It would not be surprising to see an A, B, C move down to around 92.44. That is probably still our favored side, but at some stage, unless we can bust this 92.44 area with some conviction, it looks like we will get another leg higher and probably all the way up to 96.50. But for the time being, certainly for the best part of next week, unless something incredible comes out of the Fed, that is your range, and eventually it looks like one more leg up to 96.50 before we see the retracement. But let's not anticipate it. There is absolutely no point to that. The market will certainly be very well supported around the 92.40-50 area. We can say that there is definite rotation towards US stocks and out of European stocks, i.e. not out of European stocks so much, but the buying is of US stocks. This chart of the transports is now also breaking the top part. It'll go higher eventually towards the 11,300-400 area, so that's a further 2 or 3%. We have closed again very strong on the Dow. We are through the Bollinger Band, and these retracements are minimal retracements while the Bollinger Bands move out is what we saw here in January, and the market just continued strong. That is what we're seeing at the moment. And let us have a look at ES. This 10-minute chart of just the US session is actually very telling. This is a strong trend. It just is. It's not making any concession to the bears. As soon as it opens, there's buying. When there is a bit of selling, it's very limited. The open is bought or very soon after the open, and the close is strong. Therefore, we can tell that this market, unless something comes out of the Fed next week, will probably just consolidate and then move higher again. On the dailies, we have the market actually hugging the upper Bollinger Band. It hasn't got the strength to maintain above the upper Bollinger Band, which means the volatility to the upside is very limited, and you will see, although you might see higher highs, you'll also see probably lower lows. 2748, 2750 of this moving average is now very important. This red moving average is very rarely violated on a closing basis, is if we have a strong market. All the indicators are still that we will slowly grind higher to at least this 2800 level, and then we see. But certainly the first couple of days of next week, while we don't expect any gains to be maintained, we would like to see the market on Wednesday hold this 2750 area where this red moving average will be, and then towards the end of the week we could bust through towards 2800 and maybe even higher. And actually NQ is quite telling here, because what we see is a market which is actually ahead of ES. It busts through the Bollinger Bands. It can never sustain above the Bollinger Bands. It's come back to the break level on the Bollinger Band and held it and closed quite strong. This to us indicates that the relationship of NQ leading at some stage is going to be resumed. Give it a few days for these Bollinger Bands to go up towards 7,300 and you'll see the market spike to the higher level. We have now here a correction in the stochastics, another few days of correction, and then the market will be ready to resume the march higher. I want to show you a few spread charts just to show you how insignificant this backup in tech has been. This is SOX against the yen, and basically it holds the 200-day moving average beautifully. It's turned the 50-day, the 200-day is going higher. This market is going to be very well supported around that line. This is just a healthy retracement in a bull market, and back up we go. Absolutely no weakness discernible in tech. What actually is discernible is gold over copper. We are coming down towards just about new lows for the year. That is, to us, is an indication that yields will rise, and really you can be short of bonds. It's likely that at some stage we will have higher bond yields as a result of this relationship between gold and copper, and that eventually will be bearish for the stock market, but not yet. The initial reaction is a boost to the stock market, and certainly even a boost to the greatest components of the S&P. One of the greatest components, the second largest component, which is XLF. So that is why we think there is very little likelihood of ES breaking down. We have more of a likelihood of bonds breaking down as a result of this spread chart. Gold over silver is also breaking down, and to us that indicates demand for commodities. This to us is actually quite a bearish sign for bonds, and also quite a bullish sign for equities relative to bonds. Definitely this is indicating that bonds are going to be better offered than commodities. Compare and contrast these spread charts between SPY and DBC, which is commodities in general, and this is SPY and gold. Gold actually is now trying to make new highs for the year. This indicates further appreciation of equities compared to gold, and this chart is nowhere near it. Therefore, be careful of gold. That says to us, be bearish of bonds and bullish of equities, but probably especially XLF. A very important chart, XLF over SPY. You can see what happened the week before last when the bond market went berserk to the upside. It just collapsed through the trend line and below the 200-day moving average. We now will go and retest that break to the 200-day and to the trend line. What happens there is going to be pivotal for the rest of the summer. If SPY cannot hold, that means that bonds are bid relative to equities and that yields are coming off, i.e. weakness in stocks. If we regain it, we might go all the way back up to the top, and we will see the bond market probably break out above 320. This is a very, very important chart, and what happens here sometime next week is going to be paramount and key for the rest of the summer. This is the outright chart of XLF. At some stage over the course of next week, we will trade 28.30. What happens there is going to be very important. Either we break higher or we come right back off. And this has massive implications for bonds. 28.30 is going to be very, very important, and that is what we will look to see what happens and put on positions in equities and bonds as a result. Well, the biases have not really changed. FV and TY, we're still sellers of the straddle. We've made some nice money this week out being short of the straddle. It's not changing very much, but we will now wait and see what the Fed brings. Bonds and bobble, as we thought, the short end is going to be more bid than the long end. The yield curve there continues to steepen, and there is no reason to stop it. The equity markets, we thought they would be weaker than they are. We said, look, watch for behavior at 27.60. Well, it was at 27.60 on Friday morning, was it not? And it closed strong. It's strong, but it will have dips. So no need to chase. Certainly in the early part of next week, it's more likely to dip than not dip. NQ was probably the underperformer last week, but it's such minor weakness that we are quite sure it will be result of the upside. Certainly no reason to sell XLK. Nothing has happened. But what we will watch, as we explained, is XLF on an outright basis at that 30 level, and also against SPY, and that will be the main thing that you need to concern yourselves with next week. European equities, as we said, no acceleration for the time being. We need some clear signals out of the ECB or something much better to come out of Italy to be able to express our opinion there. And DX, not a lot of change to what we thought. It is actually stronger rather than weaker. Our opinion is slightly changing towards a stronger dollar than a weaker dollar, and that actually is a headwind for US equities, but that is neither here nor there at the moment. It'll all be decided by XLF next week. Thank you very much indeed, and have a lovely weekend.